We're glad to have you back. The signing of Nigeria's 2023 budget seems to convey a strong sense of duty, as well as the government's commitment to breathing life into the economy. But nothing could be truer than perhaps the very opposite. All things being equal, if government goes ahead with its spending template as planned, the total budget per capita is $224, when that's about 10.4% of what the South African government spent in 2021 and less than a quarter of that of Egypt, one of Nigeria's regional economic rivals. This begs on the value of this year's appropriation bill. Are these benefits worth the many severe costs of the budget? Well, let's get some analysis on this spending plan. And I'm being joined by no other person, the president of the Association of Capital Market Academics of Nigeria, Professor Uchenna Uwaleke, Professor of Capital Market. Thank you so much, Prof. It's good to have you on the show. Happy New Year to you.
Yeah, thanks so much, Tolu. Happy New Year to you.
After the National Assembly wrapped up the budget, after checking through and coming up with 21.83 trillion naira, with an increase of about 1.31 trillion naira. First, I like to always start this discussion this way: is what do you make of the actuality of this document, the practicality of this 21.83 trillion naira that has been signed into law?
Well, the practicality, if I may borrow your words, is going to be pretty difficult, very challenging on many fronts. The first thing to note that this is a transition budget, and if you check our recent experience, if you check what has always happened in any year we are transiting from one administration to the other, you would find that the outturn in terms of implementation is usually nothing to cheer about, because it's a transition budget, because the budget or the document has been prepared by those who will eventually not be there to implement it. So you should expect that the next administration may have a different emphasis, particularly if it is not the same political party. And remember, the budget is nothing but a tool by which government, assign priorities. It's a tool for planning, and the next administration may have its own, priorities different from what that is already in place. So to that extent, you should expect that come July 2023, that's talking about the second half of the year, the implementation of the budget is likely going to suffer. So the first risk I see is the risk arising from the transition process. The second risk I also see, the major challenge I see with respect to implementation, has to do with even the assumption that oil subsidy, fuel subsidy, will cease by the beginning of the second half of 2023. So far, they have budgeted 3.36 trillion for fuel subsidy, on the assumption that it's not going to continue, with effect from July. But again, that is unlikely. Unlikely, even with the Dangote refinery we're expecting to come on board. It's very unlikely that the next administration will remove fuel subsidy almost immediately. I don't see that as being, practical or feasible. There will be some time. I also will, naturally, you will allow the next administration time to settle down before implementing that kind of, if you like, very sensitive, this decision. So that's the second risk I see. The other one I also see has to come from the benchmarks, that have been used. Remember, the total revenue projection is 10.49 trillion. And out of this 10.49 trillion, a significant part, about 2.3 trillion, will be coming from oil revenue, representing 22% of the budget. And that revenue projection, oil revenue projection, is predicated on the attainment of the benchmarks used. Number one is the 1.69 million barrels per day production, and of course, the $75 per barrel oil price assumption. So what that means is that if any of these, doesn't materialize, doesn't crystallize, again, we'll also have a lot of challenge there. And remember too that there is also this issue of exchange rate. Exchange rate at 435 naira to the dollar, the target. Meanwhile, as we speak, the official exchange rate is around 450 naira, to the dollar. And to the extent that the budget has some dollar-denominated components, particularly the capital component, to that extent, you should also expect some distortions in the, budget outcomes for 2023. So essentially, Tolu, I think it's going to be a very difficult one to implement, given the fact that it's one budget that has very huge deficits. You are expecting 10.49 trillion and you are spending 21.8 trillion. You can see the gap. The gap is so huge. What that means is that if we also have difficulty getting the much we plan to get from external sources, I think about 1.7 trillion, that will also pose, some challenges. And even with respect to the one we want to source, the amount we want to source domestically, over 7 trillion naira, what it also means is that for government to raise that kind of money within the domestic economy, you should expect that interest rates, will be very high, in 2023. So however you look at it, it's going to be a very challenging year, a challenging budget to implement, given some of these realities. Again, remember too that there is a 6.3 trillion naira debt service component. So I was just looking at it. We expect to end 10.49 trillion. Debt service is priority payment. We make debt service of 6.3 trillion. That leaves us with just about 4.2 trillion. So the 4.2 trillion is not even enough to take care of recurrent spending. Because even within the recurrent spending, you have personnel costs of about just 4.2. So it's just enough to pay salaries. You have not talked about overheads. You've not talked about over other recurrent components. So it's really a very difficult one, as I said. And in terms of practicality, again, to borrow your words, I see the chances are very slim.
Prof, that was rich, I must say, but as usual, we're not expecting anything less. Let me follow up with this issue around the ways and means when they say our public debts might hit 77 trillion naira. There has been this argument, and even getting a message now, right now as you're speaking, talking about it here, and someone saying that, tell us more about this plan to restructure the ways and means advances, considering our debt burden at the moment.
Well, I think we have come to a point where it has become inevitable. Unfortunately, over time, our extant laws, talking about the CBN Act, has, with respect to lending to the federal government, unfortunately, has been in the compliance, has been in the breach. Remember, the CBN Act, clearly says that the central bank, in its capacity as lender of last resort, of course, can always come to the aid of the government, but with a cap. It says it should not exceed 5% of the previous year's government actual revenue. And even when that is done, before you do the next one, before you extend any next facility by way of ways and means, you should ensure that the one you have given out before, has come in. So that hasn't happened over the years, and you can see the result. It has now accumulated to as much as 23 trillion. Okay, the government's debt to the central bank. So I think we have come to a point where something has to be done about it. Of course, the central bank balance sheet is suffering as a result of this, and except it is restructured, I don't see the government having the capacity to pay off. And that restructuring is what they're talking about with respect to securitization. Securitization simply means issue securities to investors, members of the public, to take them up, and then quickly provide these funds to the central bank. Over a 40-year period, repayment will be made at 9% interest rate. Of course, if that is done, yes, what it will do is to provide some form of relief to the government, in terms of meeting these obligations, to the central bank. But of course, going forward, it's important that that kind of restriction on ways and means extended to the government, should be complied with. We have seen the effect over time too. It has really manifested in high inflation rates. Part of why inflation rate is high today in the country is also attributed to increased money supply, and particularly on the part of the government when you have this spending that is not geared towards capital projects. Of course, I don't expect short-term borrowings from the central bank to be used for capital projects. So usually what they do is to use it for recurrent. And that is where the problem is. And that is why we see that this distortion in the economy, helping to contribute to inflationary pressure. So I think against this backdrop, I will lend my weight to my voice to the call to really have it restructured over that 40-year period. But again, the fears, being expressed, have to do with the fact that the interest rate the government is talking about is low, currently below, what you have in the market. If you're offering these securities as 9% for a 40-year, bond, that you may not really find investors except you increase, the rates, or except the central bank decides to bear the remaining burden. But I also know that in some other climes, I think UK, Europe, particularly last year, I followed the debate with respect to whether the Bank of England should even write off the debts being owed by the government to the Bank of England. That was a debate. A lot of people got involved in, last year. But I'm not saying that should be the case here, so that we don't, encourage we don't create moral hazards or encourage that kind of thing with respect to subsequent regimes. The government should pay, find a way of paying, and for them to be able to do that over a longer period of time, securitization, would be the best approach. But of course, whether it's securitized or not, I've just told you, 2023 is going to be a year with that will experience, high interest rate environment, because, as I said earlier, the 9% may not be attractive to investors. One, so that may also force some adjustments. But essentially, if the government is going to borrow much from this domestic economy next year, as is being proposed, you should expect that interest rates will be high. And high interest rates, we know how it manifests. Businesses usually have difficulty accessing credit. So credit to the private sector may diminish as a result of high interest rates. Banks' asset quality may also diminish, because when you have high interest rates, what usually happens is that the non-performing loans also rise. Central bank has a threshold of 5%, so we may have non-performing loans ratio being well in excess of 5%, for banks in 2023 on account of, high interest rate environment. And of course, I don't also need to tell you the negative impact that will have on the equities market.
Prof, a lot is said already, but before I let you go, because considering this consolidation and transition that you've mentioned already, I wanted to touch on what sort of infrastructure development we should be looking at. But it seems like all of it is focused on politics at the moment. But do you still think that whichever way, whoever becomes the CEO can take up some of these major infrastructure projects, considering all of these challenges that we have surrounding the spending plan?
Well, as I said, I don't envy whoever emerges as president in 2023 because of these, challenges that, are confronting us. The headwinds, domestic headwinds, are very much there, very much, visible. Whether you're talking about inflation rate is going to be higher in 2023 for obvious reasons. We're also going to have, we are likely to have weak, real GDP growth. Again, on account of the fact that you have a budget that is more weighted to recurrent than capital. So these fiscal challenges will feed into the level of economic activities, and then you should expect that the economy may slow down. Already the IMF has revised downwards projections, growth projections for Nigeria, as it has also done for the rest of the world. Remember, it's projecting that 2/3 of world economies are likely to be in recession, experience recession in 2023. So Nigeria's growth forecast too has been revised downwards. So it's against this backdrop that I said I don't envy, whoever emerges as president. But I think too, the first thing I expect the new administration to do would of course be to hit the ground running from day one. And by that I mean, within the first 3 weeks, first 2-3 weeks, I expect to have, get him have his cabinet in place, appointing the right people in the right places. For example, there are ministries that ought to be professionalized. You don't just appoint anybody as a Minister of Finance. The Minister of Finance must be somebody with the, required requisite knowledge and skills to be able to function in that capacity. So once you have the right people working for you, what you now need to do will be to also address the immediate challenges, one of which is this removal of fuel subsidy. Because if fuel subsidy doesn't go as already provided in the budget, the administration is likely to have serious challenges. And one way to remove that, and that's why I've also said, that this is the time to even begin to engage stakeholders. It is not by June or July that you start engaging stakeholders. This is the time that the government needs to start engaging stakeholders, engaging labor, getting the buy-in of labor, and putting in place compensation measures. When I listen to presidential candidates on, virtually all of them are talking about removing fuel subsidy, but I have not heard them talk about, the way to go about it. The compensation measures that must be in place in order to, have a hitch-free, implementation of the fuel subsidy removal. They hardly talk about that. So, and as I said, this is the time to begin to, do that. So once the immediate challenges, are taken care of, I think it should be easier for the government at that time to now implement its programs. And it's also important for the new administration, regardless of the political party that will be there, to also ensure that some of the things that are already in place now are continued, okay? So that the new person doesn't come and jettison some of the, at least if you like, good initiatives that are already in place not today. One of which is the Strategic Revenue Growth Initiative, of this administration. Of course, there may be need to modify it, but it's important that that is continued, okay? And if there are projects that are already in place, I also expect the new administration to, to see them through and not to jettison those projects. So I think recognizing these challenges and having people with the right skills and knowledge to man various positions in place, for me, that's getting the problem even half solved. And that way too, before you know it, confidence will begin to return to this economy. Once the perception is out there that a new person means business, he has the right people around him, confidence will return. Local investors, foreign investors will begin to come in, and before you know it, we will find capital flows, and once capital begins to enter this economy, a lot will begin to change. Reserves will begin to grow, exchange rate will begin to firm up, and you're also likely to find inflation rate even cooling, even slowing. So, as I said, it's important to take the right steps, and in time too, once the new administration comes on board.
It's a good way to leave it. I must thank you so much for your contribution to the show in 2022, 2021, and now it's 2023. I appreciate this, and all members of the team are also sending their regards. Have a great day, and thank you very much for joining us on the show. Professor Uchenna Uwaleke is the president of the Association of Capital Market Academics of Nigeria, ACMAN. Thank you so much again.